Welcome, guys. Welcome to another episode of, another educational segment with the Cryptoverse DAO. Today, we're going to be taking a look at technical analysis, what this means. You've probably heard it touted a bunch of times. You've heard, hey, join the Cryptoverse DAO. We've got technicals. What does that mean? What is a technical? Technical specifications? What is it? We're going to tell you. Before we kind of roll into what technicals means, what a technical analysis is, and how to conduct one, and why it's useful, and what purpose it serves. Before we get into like the meat of it, I would like to remind everybody, if you're catching this on YouTube, please do subscribe. Please do hit that bell, as all the YouTube people tell you to. I don't know what good it does, but apparently it does a lot of good. Hit like on this video if you liked it. If you didn't, drop a comment. Let us know that you didn't like it. Let us know why you didn't like it and what we can improve for next time. Because end of the day, we want to be bringing value to you. We want to be empowering you to make informed moves within the DeFi space through education. So here's what a technical analysis is, right? It's basically an analysis of charts in like super simple terms. In looking for a stock, the following are the key technical analysis tools that should be met. Not necessarily all, but most. Christ, man, that's all good. Trends and trend lines. Trends can be classified in three ways: up, down, or range bound. I think the best way to do this would probably be to actually pull up a chart for you guys. So what it basically means is, you see this right here is a chart. This is how you take a look at the data for any asset that you would want to trade over a period of time. These little red and green things. They're called candles, right? So imagine a graph. You have an x-axis, you have a y-axis. This axis right here, this is value or price. That's what this one is. And it's against time. That's this axis down here, right? So price over time basically is what you're looking at on a chart. If the candles, these things are called candlesticks. And the reason they're called that is because, well, look at them, right? What do they look like to you? They look like candlesticks to me. That right there, perfect example. There's a body, the wax of the candle, that's the body of the candle. And then you have these lines, which are called wicks. So just to give you a basic understanding of what that means, the way to read one of these things, opening, like price at the open of the candle. So these can be split into different time frames as well. So let's cover it one by one. So it's price over time, right? The time frame that you're looking at is subject to change as well. You could look at this right here. You see up here, it says 15 minutes. You could have a 1 day chart. You could have a 1 week chart. You could have a 1 minute chart. You could have a 30-second chart. You could have a 1 second chart, right? And what it does is, again, it collates price against time within whatever specified time frame you're looking at. That's what all of that basically is. Now the candles themselves, let's say you're looking at the 15-minute chart. Each one of these lines represents price action within a 15-minute period. If you're looking at a 15-minute chart, if you're looking at a 3-minute chart, one of these candles represents price action within a 3-minute period. If you look at 1 day, 1 week, so on and so forth. Now, what does this mean? So 15 minutes, at the start of the 15 minutes, this was the price. This is the, actually, wait, hold on. I'm going to, instead of explaining it here, because this is supposed to be a generalized overview, what I will say is go to our education episode on Japanese candlesticks, how to read the candlesticks, because I'm pretty sure there's a segment in which we explain specifically. I just don't want to repeat the content, essentially. So join the Discord. It's in the description down below. All of the educational content is on there, but if you don't know how to use Discord or whatever, on the YouTube itself, go to our playlists, education, find the candlesticks episode, and watch it. Very basically, where the price like opens, closes, and the averages. And you use the body to kind of gauge direction a little bit. So if it closes bearish or closes bullish, if it closes with more of this on the top or more of that on the bottom, that can change things. But again, getting ahead of myself, let's keep things very basic for this specific episode. Now we're talking about trends, right? We're talking about trends as well. Trends can be classified in three ways: up, down, or range bound, right? So up, basically very self-explanatory. It's going up in green. That's what the colors are. Green basically means the price in general over this period has been moving in the upward direction. It's been increasing. A red candle, excuse me, represents the fact that the price has been in general during that period moving downward or decreasing. And these things, they're called dojis. Again, that's something we covered in a different episode. So what does range mean? That's the next question. You know what up and down means. What is range? Range is effectively, so here, you see this candle, it opened at this price, closed down at the bottom here. That's kind of like the average motion. Yeah, same thing. This one closed very bearish. This one closed kind of bullish. And then there was like a motion upward. So you have the green candle, another green candle. And now what does this mean? Price opened here, opened, and it moved from down here to up here, to up here, to up here. And what is that? That's an uptrend. That's upward motion, right? That's an upward trend. So upward trend keeps going, and then it stops. And you see this flat area, that right there, that's what's called a ranging market. That's range. When the price doesn't really commit to moving all the way up or all the way down far enough for you to take a meaningful trade, far enough for you to kind of, if you can't like clear your spread even, because the price action, if you look at it, it's really fluctuating. If I could draw a line, it's really fluctuating between here and here. Like it's not broken below this, right? And it's not broken above this for this period of time, which is however many 15-minute candles, right? So from like 1:30 p.m. to about 8:30 in the morning, ranging markets. You shouldn't be taking a trade during this time, is what people would say. In an uptrend, stock rallies often with intermediate periods of consolidation or movement against the trend. In a downtrend, again, that would be something like not really a lot of downtrends in this specific one. Imagine this graph was flipped horizontally. If it had moved in this, if the motion was in this direction, if it was going right to left instead of left to right, this would be that right there, downtrend, range, downtrend. Right now it's uptrend, range, and a small uptrend, range, and then yeah, same thing. Downtrend is just downward motion, effectively. In a downtrend, stock declines often with intermediate periods of consolidation or movement against the trend. In range bound, there is no apparent direction to the price movement, right, on the stock chart, and there will be little or no rate of price change. These trends can be measured using trend lines. All we want is stocks that are in rising trends. Let me do something really quickly. Can we do... Actually, no, I don't want to... Yeah, that's fine. I would say... Yeah, let's just continue with this. So, in range bound, there's no apparent direction. Like I said, doesn't really make sense. You don't want to be committing to a trade in that type of market condition because you can take a look at this and be like, oh, it kind of, it closed kind of bearish-ish a little bit, and then it's red, and then a doji, so maybe it's going to go down, and then it doesn't. It just goes over here, and then goes down here, and gives you a little bit of hope, and then goes all the way down here. If you were in a buy or a sell and you entered at, what's the ideal, like here, if you entered at the bottom of this candle, then no matter what direction it goes, it's not really going to be that great, because if you're in a sell, you might go down to here, barely going to clear your spread. It's not going to be that great of a trade, and you're going to be constantly wanting it to go down, and then when it goes back up, you're going to be like, oh crap, oh fuck, now I'm in loss. And if it ranges, sometimes with ranging markets you can see like this, like little fuck you wicks. You see this one? This is the price drop drastically from here to here. That's the average, but that's the like highest price, the most intense price movement, right? You could be in a trade and you would have your stop loss set over like here, bottom of this, bottom of that, right? And then like the price really hasn't on average moved that much, but it just goes down, and it breaks you out of it stops you out in loss, which is not what you want. And then that's going to play with your emotions and make you feel like shit because it's going to go back up here. Um, and you're going to be like, oh man, if I didn't get wicked out, like, oh man, I should have set a higher stop loss. And what does that do? That encourages a bad habit. You don't want to be doing crazy open stop losses. Trend lines. Effectively, you see this blue line? That's trend lines can be drawn effectively when I say things like around here. That's like a trend line. You can measure where something closed, or where something opened. You can measure the highs and the lows, the lower ones or the higher ones of each, and use that information, that data, to chart or to extrapolate, um, mathematically, well, geometrically, really, to geometrically extrapolate what the price is going to do in the future. That's what, when people talk about this, like, look at this channel, if someone says, look at this channel, that's basically the area between two trend lines, which means, which kind of suggests, it doesn't really dictate price, because if you see this, this line over here, it makes sense as a trend line, but you see this deviation. There's still going to be deviation because there's always manipulation in the markets. There's always, it's not always a perfect system. Although it could be, supply and demand could be a perfect system, but it's not. All we want is stocks that are in rising trends. I don't know about that. I mean, you can scalp, you can make money off of shorts. You can scalp things. You can do swing trades. There's so many ways to make money. It's not just buy one Bitcoin, please, and hold it, and now I'm a millionaire in next year. That's not. It's not just that. There's endless possibilities. Let's talk about support and resistance. This basically tells us what price levels are likely to bring put buyers, what? Or the sellers. Okay, I don't know. But basically, support and resistance is if the price kind of like hits a level and then bounces, it sets kind of a support floor, right? If the price continually bounces off of, even here, you could argue that right there, that's like a mini support floor. You could call it that. Between here and here, you could call that a support floor because it always hit and then bounced back up. That's a support floor. If it's on the upper bound and you're saying, okay, it hit this ceiling and then bounced back down, that's a resistance ceiling or a resistance level. Now every chart that you look at, it's not like you look at the one big A4 sheet of paper and it has all the information. You're looking at charts like you're looking at 15-minute charts, 3-minute charts, daily charts, weekly charts. You can have trend lines for each of them. You can have a weekly resistance, right? And you can have a weekly support, the highest price and the lowest price for the week. And then what you can do is you can go into a smaller time frame, and within that smaller time frame, you can do the same thing, right? And then what this will do when you create these trend lines on a platform like TradingView is that they will all appear on your screen at once when you're in the trade. So what you can do effectively is use, it's very simple. Just go to the weekly chart, find the highest price and just mark that as the high, like all-time resistance. Find the lowest price for the week and mark it all-time week or week-long support. Do the same thing for the day chart. Do the same thing for the hour. And what that'll do is it'll give you the bounds within the price, the bounds within which the price is more likely to operate than not. Effectively, that's kind of what support and resistance is. Here we want to see that if the current price has either just moved through resistance or one that is far from the next resistance level. Yeah, I mean, fairly self-explanatory. That right there, that's a pretty good, doesn't seem to be opening, but that's all good. This right here, that is that line, the gray line, you could call that an uptrend support line. Because what does the price do? It fluctuates down, bounces off that level, comes down here, bounces off that level. It doesn't have to be just a flat line, right? You could call that an uptrend support line. If it bounces, straight on, then sure, that's a straight support. This one's an uptrend support, right? And the same thing for resistance. If it continues to go down in a uniform fashion in a direction, boom, that's a downtrend resistance line. Now let's talk about moving averages. Let's talk about that. Moving averages basically, well, it does what it says on the box. It's it's an average of movement data, price movement data, right? An exponential moving average or an SMA or an EMA, whatever it is. What these things do is they help in determining if the trend is turning or changing direction, right? Also, it shows if the existing trend is progressing in an orderly manner or not. What does that mean? It basically means it tells you whether it's a good gauge for manipulation in the market because, like I said, price should follow supply and demand almost perfectly, but it doesn't because entropy and we're humans. So what an EMA does is it kind of accounts for that, or an SMA, it kind of accounts for just a moving average, accounts for it. What this will do is it'll collate data from like a 20-day period or a 10-day period or a week-long period. You can set the parameters when you add a moving average into your chart or against your chart, I suppose. And like I said, what it does is it collates long-term and short-term data to provide you with a visual indicator of average price movement. And you can use that average price movement visual indicator to kind of inform your moves because you would know, let's say if the shorter term and the longer term one crossed over up, like look at this blue line, yeah? Blue line crosses the red line downward in a downward direction, right? It doesn't go from, like right now, it's not below the red line and crossing up, it's above it and it crosses down. And what happens to the price? What happens to it? It goes down, right? It goes down. That's a downtrend. And what happens here? There's a lot of distance between the two. And what do you see? Ranging. You see a ranging market. And then you see the start of a little uptrend, bounces off some kind of invisible support. I'm sure you could have drawn like a downtrend or something. You could draw something. There's a reason that happened. It comes down, right? Continues down. After that initial cross downwards, it's still riding. I wouldn't call that a ranging market because that's a pretty short time frame. It's still riding that downshift momentum. It's still in, you're still in a sell, right? So if you're an astute trader, at this point, obviously you would have like 4 or 5 more indicators as well to kind of give you that extra confidence that you need, and you would be following the trading strategy that you have set for yourself, and you would be chasing the profits that you know you want to chase because you have that number in your head already. So there's no emotions in it. So what you can do is, as soon as you have that final indicator here, you would enter here, you'd be in profit, and then you'd come just to about break even about here, right? And you'd come back down, you'd continue riding that wave. Now, I wouldn't close a trade at that point if I was in a sell because, again, the EMA hasn't crossed up. That doesn't mean that, because there are pullbacks and reversals and this, that, and the other. What that means is price fluctuates, right? So when the exponential moving average does not tell you that the direction is about to change, it's most likely a pullback. So don't shit yourself yet. Hold it in. Shit yourself later because other things can happen as well. So it's going to keep going down, keep going down, keep going down. And then what happens here? Finally, boop, crosses from down below to up above. And what do you see happening? Price begins to move in an upward direction. It hits a support floor here, right? Hits a support, bounces up, tries to go down, bounces up again. So that's a slight upward uptrend support line. And it continues to go up, right? Continues to go up until it crosses again and the direction shifts and it begins to go down. So a really great way to visualize how the market is feeling, kind of, and how you should be feeling in relation to the market. Let's talk about relative performance now. This divides the price of a stock by a relative market index or industry group. Here's the theory. Here, the theory is to find out if the ratio is going up, the stock is outperforming the market. What? Here, the theory is to find out if the ratio is going up, the stock is outperforming the market, and is thus a strong candidate for further gains and vice versa. Okay. Here we are looking for stocks whose relative performances are increasing. This is in reference to like there's a type of indicator called a relative strength index, an RSI. What that does is, again, what these indicators literally do what they say on the box. That's literally what they do. And a moving average gives you a moving average, an average of motion. A relative strength index or relative performance index or whatever it is tells you the relative strength of the motion you're looking at, right? So if the way a relative strength index looks is picture a support and a resistance line and picture a EMA inside it. If the EMA goes up above the resistance, that means like if it's hovering above the resistance and it re-enters the channel or something like that, that's strength of the move. So if it's above the, let's call this image the upper bound and the lower bound. If it's above the upper bound and it comes down, enters the channel and continues going down in that direction, and you see the EMAs cross in the way that you did for the sell motion down here, then that's two really strong indicators that the price action is about to move in one specific direction. And you should feel a little bit more bullish about taking a trade, a little bit more, not bullish, a bit more confident in taking a trade. Volume. This is another term you'll hear thrown around during technical analysis or just during charting sessions or whatever it is. Volume is basically how much money is being traded in one time, the number of shares traded. There are indicators that show you volume as well, but like the thing is, usually if you see a ranging market, right, that means minimal volume. Volume is kind of like the gasoline for the price action. The more gasoline you've got, the more powerful the combustion is going to be. The less gasoline you have, yeah, sure, it's still going to move in the direction it's supposed to, but it's going to be like a fart compared to like a jet engine combusting, you know, or like blowing up. That's effectively the difference. And this is why kind of like the next question is probably going to be like, how do I know when volume, like if I don't know what the trade during the trading sessions. The trading sessions exist. When I say trading sessions, I mean London, New York, Australia, Tokyo. Those trading sessions, pretty much it's like around the clock. But during specific times, there are more people awake, alive, trading, which means there's more volume in the markets, which means there's more money to be made because the prices are volatile. When you're leverage trading, for example, what you're doing is riding the motion. So a really volatile market, if you're an astute trader that's using your indicators correctly and your theories correctly and, you know, this, that, and the other, and your emotions are in the right place, a volatile market is such a moneymaker. It's a brilliant feeling because whether it's up or down or wherever, all you want is a lot of motion because you will be able to read it. That's something to be just a really important thing to be said. You can't predict price. You cannot predict price. It's impossible to predict exactly price. But you can react correctly. You can act correctly in accordance to what the price is telling you. That's what you can do. And the way to do that is with these indicators and with an understanding, a thorough understanding of what it is you're looking at, right? So that's volume. Let's talk about momentum. We want to know if the days when the stock rises outnumber those when it doesn't rise, when it falls. If losing days are more and more frequent, then we might say that the trend is weakening. That makes sense. Momentum, again, what it says on the box. Now you know about support and resistance. You know about bouncing off of levels. You know about exponential moving averages, this, that, and the other. And you know about price action. You know what these things are and what they mean. So if the direction seems to be kind of waning, you know, if the energy seems to be kind of losing. So let's say strong uptrend and then it kind of peters out, right? Or we're in like a huge downtrend and then it just starts to range and it stops, right? Or we have a huge candle and then boom, it just stops. That's a loss of momentum. Yeah, so if the days when the stock rises outnumber the days when it falls, that's what we want to know. And if the losing days are more frequent than the winning days, then you might say that the trend you're looking at is weakening. Next thing is sentiment, market sentiment. Again, with TradingView, there's a little indicator right somewhere that shows you, it's like a fear and a greed index. It shows you whether people are bearish or if people are bullish, what the market sentiment is. Because at the end of the day, you know, it's not a perfect system because human emotions and human opinions and human sentiments, they affect the price. They affect supply and demand, right? So it is to find out if everybody's thinking the same thing. Is it time to go the other way? Here we want to know what everyone's thinking about the same, bro. Yeah, basically that's what sentiment is. Why use technical analysis? The next logical question. I mean, bro, why would you not? Like, literally, you can make so much money if you learn how to do this. This is how you print money. This is how all these people have Lambos. This is how it's done. Literally, learn this. And join the Cryptoverse DAO because we have people that can teach you this stuff, right? Very, very, very important. Very like life-changing shit. Life-changing shit. This could be reading this article, clicking the link down below, joining the community, right? Those three simple freaking things could be the difference between you continuing to slave away in a 9 to 5, working towards someone else's dream, usually a stupid fucking dream as well, right? And making like money that you're not super happy with, living a life that you're just barely, you're not unhappy, and that's enough. Is that enough? That's not fucking enough, bro. If you want to change your life, yeah, join the Cryptoverse DAO. I can't chill it any better than that. So yeah, the answer to this is that it has the ability to recognize when a stock has reached support or resistance level or a shift in perception takes place, can help investors take investment decisions. Yeah, basically, why use it? Because you can make money. And it's important to kind of, just in a general life sense as well, this type of analyses push the correct, well, I shouldn't say correct, they push the type of mindset and the type of ideations within yourself, you know, the habitual ideations that are going to push you really, really far because it pushes strategic thinking, it pushes analytic and critical sort of thought, you know, these kinds of things are quite important. Buy low, sell high, that's an approach. Buy high, sell higher, that's not a good approach. Or whether to even buy the stock at all. The ability to apply these aspects of the chart will reveal the market to investors when it is safe to buy a stock or not. Technical analyses is the only investment decision discipline that tells you when you are wrong to minimize losses. Goals, seeing where the stock is currently trading, figuring out how it got there. This can be done using charting tools such as the stock trends, yeah, support levels, resistance levels, we've covered that. We can find patterns and trends as well. We'll get into that in just a second. Determining the power of a trend. This can be determined by looking at the important technical concepts such as trading volume. Yep, we've covered that. Momentum, we've covered that. Making comparisons of the stock to the market, peer companies, and itself. This right here, that's what, if you've heard the term fundamentals thrown around, some traders will have this site called Forex Factory open as we trade, like looking at news that could affect the markets. Because why? Because of this sentiment. Because sentiment, once again, affects price action, right? Sentiment is informed, unfortunately, by news, um, and then just what's going on in the world. So, Fed, like those really boring news pieces that you just skim by on the daily, those are quite important. Apps like Finimize, there's a reason that they exist, to kind of push this kind of knowledge, um, because the fundamentals, it helps you inform. Treat this as one of your indicators, for whether to take a position. It informs it better. Um, so there's chart patterns, technical indicators. Chart patterns are a subjective form of tech analysis, where technicians attempt to identify areas of support and resistance. Yeah, so the difference between a chart analysis and an indicator is something like this, where data is computed in order to give you an indication of a trend or a shift or anything, right? Something. Um, and again, it's not a prediction, it's a live reaction to what the price is doing. It's just presenting the same data in a different way to help you visualize things better. Chart analysis is basically drawing these trend lines. The manual shit that you do on the chart, that's chart analysis. And these are chart patterns. Symmetrical triangle, that's a bullish variant of continuation of a trend, right? Hits once, hits twice, three, four, five. Boop, 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 boop. It's going to probably continue moving in that direction. This is an ascending triangle, a continuation, which is only ever bullish. You don't see a bearish version of this. These are inverse head and shoulders. Head and shoulders because, mini support here bounces off the main resistance, breaks the support, and hits a lower support, comes back up to the original initial resistance, bounces off the initial mini support here, and then breaks through, continues, does whatever. This is an indication of a reversal, only bullish. You don't see a bearish version of this generally. This is what's called a cup and a handle. Makes sense. This is indicative of a continuation, kind of like a jagged version of a trend line, like a curvy trend line, basically. Little trend line starts off, this is the resistance, yeah, bounces off of this in a really weird pattern, and slowly makes its way back to the original, and then does a mini bounce, and then shoots back up, right? Bullish. This is what's called a falling wedge, neutral and bullish. So it's not indicative of like a shift in momentum or anything like this. Bullish, indicative of bullish momentum. This is what's called a symmetrical triangle, which is indicative of continuation. And this one right here that we're looking at is the bearish sort of variation, not the bullish one. So instead of with a bullish one, breaks up that way. This is the descending triangle. Head and shoulders, again, this is the bullish version. This is the bearish version down here. This is the bearish version of this. This is the bearish version of this. Falling wedge. This one's a rising wedge. Ascending triangle, descending triangle. And then you have a rectangle. That's something you can do as well. Continuation, bullish variant. This is the same thing, but bearish. So downtrend instead of uptrend. This is what's called a flag, where the price kind of jumps up here and then fluctuates within a falling channel, and then shoots back out. That's a bullish variant. Same thing flipped, bearish variant. Bullish and bearish basically means uppish or downish as well, just in case you weren't aware. This is what's called a pennant. So instead of a little downtrend or uptrend channel, what you see is kind of like a symmetrical triangle in here that breaks out in the bullish. And then again, same thing, but bearish. Double bottom, double bottomed up on a Thursday afternoon, sorry. Reversal indication, right? Bullish version up here. This one right here is the bearish version. And then we're brought into what is called a triple bottom, which is again indicative of a reversal. Price changes direction, right? This one's the bullish version, and this one's the bearish version. That will all be in the YouTube resources down below, so you can take a look in your own time. But I think we've covered everything. In conclusion, that's technical analyses. That's what that is. Learn it, do it, get on tradingview.com, get an account. Don't pay for the pro, you don't need it. Just start charting. Literally just start charting. Start playing around with indicators. figure it out, get familiar, and just stare at these things for a long time. Get used to looking at different time frames. See what patterns you see, man. You might be a hidden genius that ends up figuring everything out and just printing money for the whole world. So, yes, I have been your host, Dharma, Brooklyn, BKLY and the God, or Dharma Sutra, or whatever you want to call me. Thank you so much for your time. Thank you for being a part of it. Do remember to like, comment, subscribe, and I will catch you guys on the next one. Big love. Thank you for being a part of it. Bye bye.